Hi there, it's D. So I was looking at UPB's post on have the markets reached a tipping point, and I'd like to give a slightly different viewpoint on the whole scenario. So we've basically, as what Uranium Pinto Beans mentioned, we're basically at a point where bad news, people think that the Fed's going to keep stimulating, market goes up. Good news, it's good news because the economy's growing and market goes up. And as he mentioned before, sentiment is pretty much at an all-time high. And especially, I think that investors' intelligence sentiment, which those are basically newsletter writers and advisors. Investors' intelligence gave us the highest bullish percent reading since, gosh, I want to say before even 1987. So sentiment's getting really high up there. But I want to really emphasize that it's most important from a longer term perspective to not focus so much on what people are thinking, but to see what people are doing. So, for instance, back in, say, back in 2000, we obviously had the NASDAQ bubble. And in general, the entire time as this market approached its peak, the NASDAQ sentiment was really, really high. And it kept climbing, kept climbing, and it kept climbing. But alone, people thinking that the market's going to go up, that's not the perfect contraindicator, because as we can see by this chart, they were still throwing their money into the market. So while sentiment being really high could make the market vulnerable if there would be some sort of unexpected shock, we need to make sure that what people are doing still falls in line with basically what's going on in the market. So are people bullish, and are they buying because of that, or are people bullish but they're already fully invested and they're out of money, so they're not buying? Because if it's the latter case, then yes, you should be concerned. So I have an indicator that I use to see if buying is still broad-based, and the first one is just your standard advanced decline line, which all it does is just a cumulative total of advances, just the cumulative total of advances every day minus declines every day. And what you like to see is these is new highs being confirmed by new highs in the advanced decline line. So you see this high was matched with a higher high in the advanced decline line that sloughed around a bit but really didn't go into a downtrend. And then this most recent high, the advanced decline line is still pretty darn close to its high. So we're not seeing anything that's really bad. And I'll show you an example of when we did have some trouble in the advanced decline line, and that was right before the 2007 top. And as soon as this loads up, I'll show you exactly what's happening, because there we go, 10 years of data going on. So what happened is the market was going on to new highs, and at this time the advanced decline line really made a big divergence, and then by the time we got to this high, the advanced decline line was very far below that high. So we haven't really seen that. In fact, we're still pretty much right at our high. So as far as something major goes, it really doesn't sound like anything that's of too much significance is going to happen. And I use one other indicator to measure the quality of the individual rallies, and I call this my supply-demand thrust line. And I'm going to bring this up for you just a second. And this thing that I call the thrust line, once again, it measures the quality of individual rallies, and you treat it the same way as an advanced decline line. So I'm going to do a quick graph of this thrust line since 2010, and I'll show you what I mean. So Let's do this and toss in a nice line chart. And here's basically the thrust line, and what you need to be really pinpointing your focus on is what's going on now. And in 2000, this little decline here, this was during the 2011 decline, so it's not surprising that it's moving down. But with the market making new highs, the thrust line's still pretty much right at its bull market high. So it's saying that the quality of individual rallies is still pretty good. So it's saying that people are still buying, and that buying is still broad-based. And the advanced decline line says the same exact thing. So yes, sentiment is getting to the point where if there would be some unexpected shock to the economy, such as a sudden full taper or sudden halting of all asset purchases by the Fed, we would be in trouble. But from my measures of seeing what's going on beneath the surface, we're still all right. So it's not necessarily time to throw in the towel yet and jump into 100% cash, because it still looks like this bull market has a good bit to run. So there's just a counter view on that other on UPB's video, and just tossing around some thoughts. So if you have any thoughts, please write them in the comments on either of our videos, and any opinions are definitely appreciated. Thanks.